Although velocity banking is a very powerful financial strategy that can help individuals pay off their mortgage faster while also saving on interest, the truth is that it does have its risks. And just like with any financial strategy, these risks need to be carefully considered. And though it can be enticing to always hear about how much one could save with velocity banking, we feel as if it's extremely important on this channel to always look at both ends of the spectrum and carefully evaluate the risk. The goal of this video is to not discourage individuals from further exploring velocity banking, but rather help people understand that there are real risks that should be carefully weighed against the benefits. Starting out, we have the risk of losing our home. Surprisingly, most videos that talk about velocity banking fail to mention the risk of losing one's home. See, when it comes to velocity banking, we typically leverage a HELOC to implement the strategy as we borrow from our HELOC to make a large lump sum payment onto our mortgage. Once we have made this lump sum payment, we must continue to satisfy our mortgage payment along with paying back the HELOC. And this is where the risk really starts to arise. For example, let's say Joe gets started with velocity banking and makes a lump sum payment of $20,000 from his HELOC onto his mortgage. Now, Joe must continue to pay his monthly mortgage payment of $3,000, along with also repaying the $20,000 that he just borrowed from his HELOC. Joe initially decided that he would pay $500 a month towards his HELOC to bring that balance back down. When Joe did his first analysis of the velocity banking strategy, he initially felt comfortable with paying his mortgage plus this new additional $500 monthly payment onto his HELOC. However, things took a turn. Joe was laid off from his job, which meant his monthly cash flow situation quickly changed. Now, Joe is in a position where he can barely meet his monthly mortgage payment and has nothing left over to satisfy the HELOC, meaning Joe is now at risk of losing his home. And this is because when we take out a HELOC from the bank, the loan is backed by equity in our home, meaning failure to repay the loan may mean the bank foreclosing on our home. Luckily for us all, there are ways for us to mitigate the risk of losing our home, and that is ensuring we have an emergency fund in place before starting velocity banking. Although it can seem unlikely, sudden drastic changes to our income can happen. And planning for these changes with an emergency fund can be the difference between keeping or losing our home. This typically leads to the question of, well, how much should an individual set aside for an emergency fund if they are planning to implement velocity banking? And the truth is, it really depends. Planning should be done carefully to evaluate an individual's risk and unique financial situation to determine the optimal amount for an emergency fund. Moving on to risk number 2, which is all centered around psychology and money. On paper, velocity banking can look like a wonderful strategy and almost seem like a no-brainer. But as pointed out extensively by financial advisors such as Dave Ramsey, many individuals who are struggling with debt are not struggling because they cannot understand the numbers, but rather they struggle because they fail to stick to a plan. So what causes us to deviate from our financial plan despite clearly being able to see the benefits? Well, the truth is there could be many psychological factors, but one big one is compulsive financial behavior. In today's world, compulsive financial behavior is everywhere. This environment makes it especially important to consider the risk of such behavior when adopting strategies like velocity banking. Given the discipline required to effectively manage a HELOC, susceptibility to impulsive spending can derail the strategy, leaving one in a much worse place financially than where they started. Mitigating compulsive financial behavior starts with one carefully evaluating their previous behavior patterns. If you're someone who has struggled in the past with compulsive spending, your focus should really be on getting this under control before starting velocity banking. However, even if you have a previous track record of controlling your spending, there are still other psychological factors that should be carefully considered, with another big one being controlling our overconfidence. With the way that velocity banking is discussed in many popular YouTube videos, it's really no surprise that people can quickly become excited and overconfident. However, when it comes to velocity banking, this overconfidence can be particularly dangerous. That is because there are many intricacies that need to be considered with the strategy. For example, we talked extensively about the need to carefully factor in sudden changes to our cash flow due to unforeseen circumstances. However, there are still many other variables that also need to be carefully considered, such as interest rates and their terms. Unlike traditional fixed rate mortgages, HELOCs often come with a variable interest rate that can fluctuate based on market conditions. These fluctuations can introduce a significant level of risk. For example, if interest rates rise, the cost of borrowing from our HELOC can also dramatically increase, potentially negating the financial benefits of the strategy and leading to higher overall cost. Additionally, HELOCs may have terms and conditions that affect their use, such as repayment periods and minimum payment requirements. Understanding these terms is essential to avoid being blindsided by the velocity banking strategy. For example, the draw period is a time frame during which you can borrow from the HELOC, often followed by a repayment period where no further withdrawals are allowed and the outstanding balance must be repaid. Misunderstanding these terms can lead to liquidity issues or difficulty in managing our cash flow, which of course can directly impact our velocity banking strategy. It's important to always remember that everyone's financial situation is different, meaning that the benefits and risks that can come from the velocity banking strategy are going to vary from person to person. That's why it's always important to carefully evaluate your own financial situation before committing to any strategy like velocity banking. This includes doing your own research and talking to the proper licensed financial advisors. Our one ask is if you did get some value out of this video, be sure to leave a thumbs up and consider subscribing to the channel for more content related to velocity banking and everyday finance.